Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of bond yields and interest rates. What investors need to know in 2024. Ever wonder why headlines about bond yields and interest rates spark so much debate? These two financial terms hold the keys to understanding market movements and can steer your investment strategies. Bond yields often indicate where interest rates might head next, providing insights into economic health and helping investors make informed decisions. In 2024, their interplay becomes even more crucial as global markets react to economic shifts and policy changes. Whether you're a seasoned investor or just curious about economic trends, grasping the dynamics between bond yields and interest rates will sharpen your ability to navigate the financial market effectively. Ready to boost your financial savvy? Let's dive in. What are bond yields? Bond yields are crucial for grasping the mechanics of financial markets. Though they might sound complex, understanding the core concept is straightforward. Essentially, a bond yield is the return an investor can expect to earn by holding a bond until maturity. These yields offer insights into interest rate trends and economic conditions, becoming vital in times of market uncertainty. If you're looking to make informed investment decisions, having a handle on bond yields is indispensable. Types of bond yields. When discussing bond yields, it's important to differentiate between several types, each offering a unique perspective. Nominal yield. This is the simplest form of yield, calculated by taking the bond's annual coupon payment and dividing it by the face value. It's expressed as a percentage and doesn't account for the bond's market price fluctuations. Think of it as the sticker price of yield, a straightforward number without much nuance. Current yield. This type considers the bond's current market price rather than just its face value. Calculated by dividing the annual coupon payment by the bond's current price, it provides a more immediate sense of income relative to investment cost. It's like checking the price tag on a sale item rather than relying solely on the original cost. Yield to maturity, YTM. Often seen as the most comprehensive yield measure, YTM accounts for all future coupon payments and the difference between the bond's market price and its par value, assuming you'll hold the bond to maturity. It acts as a crystal ball, offering a glimpse into the bond's total return considering factors like interest rate changes. Factors influencing bond yields. So, what affects these yields? Understanding the factors at play can demystify the fluctuations. Economic indicators, inflation rates, unemployment statistics, and GDP growth are significant. Higher inflation typically leads to higher yields, as investors demand more return to offset purchasing power loss. Similarly, economic growth might push yields up as interest rate hikes often accompany robust expansions. Market conditions. Supply and demand dynamics in the bond market influence yields. A surge in bond issuance can push yields up, while high demand might drive them down. Like a crowded auction house, more buyers or fewer sellers can sway the final price. Central bank policies. The Federal Reserve and other central banks wield significant influence. When they adjust interest rates, bond yields often follow suit. A rate hike can cause yields to rise as new bonds offer better returns, while cuts can have the reverse effect. Geopolitical events. Global events can rattle markets and send yields swinging. Political instability or unexpected global developments can lead to a flight to safety, with investors flocking to bonds and driving yields down. Understanding bond yields requires delving into these types and factors. It's like piecing together a financial puzzle, where each element contributes to the larger picture. Being aware of these nuances enriches your financial literacy and enhances your investment strategies. Understanding interest rates. Interest rates are like the heartbeat of the financial world, influencing everything from your mortgage to economic growth. They tell us the cost of borrowing money and the return on savings. Grasping how they work is crucial to understanding broader financial trends, including how they interplay with bond yields. Types of interest rates. There are different types of interest rates that you should know about. Each type plays a distinct role, affecting financial products and economic decisions in unique ways. Fixed interest rates. These rates remain constant over the loan or investment's term. They offer predictability, making budgeting easier. They're like the fixed gear of a bicycle, smooth and steady if you know you'll be on level ground. When rates are set low, they're quite appealing to borrowers seeking stability. Variable interest rates. In contrast, variable rates can change based on market conditions or specific benchmarks. This flexibility can mean savings or extra costs, depending on rate changes. Imagine sailing on a day with variable winds. Your journey might be smooth or bumpy. Lenders often offer lower initial rates, making them tempting but risky. Prime rates. These are the rates banks charge their most creditworthy customers, often used as a base for setting other rates. They act like a VIP section in finance, reserved for top clients, but they indirectly affect most credit products. When central banks adjust their rates, prime rates typically follow. Understanding these types empowers you to make informed decisions, whether you're considering a loan or looking into investment opportunities. The role of central banks. Central banks hold the reins when it comes to steering interest rates, primarily through monetary policy. Their decisions ripple through the economy and can impact your wallet in more ways than one. Central banks, like the Federal Reserve in the U.S., use tools such as the federal funds rate or setting reserve requirements for banks. By raising or lowering these rates, they either encourage borrowing and spending or pump the brakes to keep inflation in check. Think of them as the captain of a ship, making adjustments to the sails to maintain a steady course. Are they pushing to speed up the economy? Then expect interest rates to lower, encouraging businesses and consumers to borrow more. Are they pumping the brakes to prevent an overheating economy? Then rates might rise, cooling down spending and investment. Central banks also engage in open market operations, buying or selling government bonds to regulate money supply. When they buy bonds, they inject money into the economy, typically decreasing interest rates and stimulating growth. Selling bonds does the opposite, pulling money out and potentially raising rates. Understanding these dynamics can reveal why interest rates change and what that means for your personal finances or investment portfolio. Having this insight is like having a compass, helping guide financial decisions amid shifting economic currents. The relationship between bond yields and interest rates. Understanding the relationship between bond yields and interest rates is crucial for navigating the financial markets. At its core, this relationship reflects how changes in the economy and monetary policy influence investment opportunities and decisions. How rising interest rates affect bond prices. Picture a seesaw. When one side goes up, the other comes down. The same concept applies to bond prices and interest rates, highlighting their inverse relationship. When interest rates rise, new bonds enter the market offering better returns due to higher rates. Consequently, existing bonds with lower yields become less attractive. Investors aren't likely to pay the same price for a bond offering a lower return when they can get a better rate on newly issued bonds. As a result, the price of existing bonds must fall to offer a yield comparable to new issues. This adjustment ensures that the bond market stays competitive and reflects current economic conditions. If you're holding a bond and rates rise, the value of your bond on the secondary market decreases unless you're willing to sell at a discount. But here's a silver lining. If you hold the bond to maturity, you'll still receive the face value. So, the impact of rising rates primarily concerns those looking to sell before maturity. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.